Change is coming very quickly to all of us, and the most important action you can do to be on the right side of change, in my opinion, is to shift from a labor-centric point of view to a capital-centric point of view. Why? Because the economy, as Elon says, is labor plus capital. Labor is being automated on an exponential basis, right? So we have AI actually improving exponentially. The IQ of intelligent agents keeps increasing, keeps raising in different areas. So more and more tasks are getting automated completely. And there is not a single task I can think of that is not being automated as we speak. And some of the tasks are still have lower than human performance via automation, but many tasks actually can already be performed better by AIs than can be performed by humans, which means that your labor is being devalued as we speak. And as AI is improving exponentially, or at least the cost of AI is decreasing exponentially, and this is we have the rights law at play, reducing the price to train an AI model by 70% every single year. As this keeps happening, our human labor, will not remain competitive with AI. So what we need to do is to shift from labor to capital, right? We need to rely on our capital. What is capital? Capital is controlling the machines, in a way, right? So if you think about this, we don't want to actually use picks and shovels. We want to use humanoid robots, right? And if you control humanoid robots, we don't need to actually do the work, right? So it's much more efficient for us and productive for us to research on the humanoid robots, for instance, or on robotics in general, than to actually do the stuff, actually do the work, because the robots can then actually do the work. And it's just one instance of leverage that we add, or one level of leverage that we add by designing the machines that then create the value we want. And on today's video, we are going to have some fun. We are going to look at different compound annual growth rate. These are hypothetical annual growth rate if we started from $1,000 at the age of 15, and then we use these compound annual growth rate to actually grow to the end value of the investment. So for instance, if we have Warren Buffett is now 93 years old and has net worth of 136 billion. If he started with only 1K at the age of 15, and he would have had a compound annual growth rate of 27% throughout his lifetime, then he would actually also have reached 136 billion. So in a way, this compound annual growth rate condenses a person's ability to compound capital and to increase their control of capital, to increase the capital that accumulates or has flocked during his lifetime to this person. And a higher compound annual growth rate will have significant higher results. So only a percentage or 2 percentage points or so can make all the difference in the world. And you see that all the richest person in the world are significant compounders, but the difference is not as big as you would think, right? So say you have the S&P 500 that compounds at 10% per year. If we start with a modest $1,000 at the age of 15, and we grow our capital, say between 15 and 25, at a compound annual growth rate of more than 27%, we would basically be faster than this like Warren Buffett toy example, right? So we would have like in this scenario, of course, Warren Buffett already was far richer at the age of 25, and then the compound annual growth rate actually declined over time. But if you assume we can reach maybe a stable 20% annual growth rate or so, then we can actually compound capital fairly quickly. And you see the if you look at the plot, we can see here I plotted the compound annual growth rate over time, or actually the capital over time of the different person we have looked at, and you see all of them actually have this explosion of net worth, right? And this happens, the explosion always seems to happen at the end of a person. So for instance, this last curve here is Warren Buffett. Here you see the explosion of net worth. At 74, Warren Buffett was actually not that big of a deal, right? So I mean, he was already rich, but he was far from he was not there was a huge difference in his net worth compared to now at age 93. So Warren Buffett actually has not such an insane high compound annual growth rate. What he has is a long period to compound the capital. So what we can learn from this as normal people, as John Doe's, basically is that we like, even if the sums initially don't seem to be highly relevant for us, right? So for instance, this John Doe who starts with $1,000 at age 15 and then starts to compound his capital very, very slowly at a 15% annual rate, right? So at age 30, he would still only have 8K. But if he keeps compounding his capital, when he goes into retirement, he would basically have a 1.2 million Nasdaq. Now think about this, or 1.4 actually, sorry. So think about this. This doesn't assume he has added any new or fresh capital, or he has accelerated the compound rate. Initially, if you start with a $1,000, you can actually double your capital easily, right? Every single year for a couple of years just by doing some manual labor, right? Or maybe you can start with 10K or so at age 15. So probably if you watch this video, you cannot do it anymore. But I mean, it shows that oftentimes, so for instance, this John Doe here starting with 1K, roughly 20 years later, he would have 10x his capital, right? At age 32. So if you are now age 32 and you can start with 10K, you would basically have the same quick start, because here the initial years are really unimpressive. You can basically replace this initial growth phase by just adding a higher initial sum or just adding your labor, because this just assumes that John Doe basically sits on his hand, does nothing, just compounds his capital, right? And of course, John Doe also needs to live, so probably he would need to compensate for that in a way. Later on, he can also either compound at a higher rate and pull off some capital, or he could simply take loans, for instance, margin loans or otherwise, against his growing capital base. And he can do so forever, like many of the ultra rich people do. And this also shows that so for instance, here in this Elon Musk example, Elon Musk was actually one of the best capital compounder on the planet. He currently, in hindsight, has grown his capital base by 66% in this hypothetical example of starting with 1K at age 15. So if Elon Musk just took 1K and he kept growing, so through the actions he did, he kept growing the capital by 66%, he would actually reach, at a very young age of 53, already the 244 billion sum, and would already be one of the richest person in the world just by growing the initial $1,000. So these kind of growth rates are basically insane. It's all about the building wealth is about having a high compound annual growth rate, and so compound your capital and compound it over a long period of time. This is the period of time part we can learn from Warren Buffett. If you have longer time, you actually don't need such a high compound annual growth rate. If you want to grow faster, then you need a higher compound annual growth rate. But initially, you can take the shortcut by just doing some labor, right? By just initially maybe taking on a job, you can make 35K in a year, right? And in 1 year, for instance, if you are at 19 and you work a full-time job or so, and you stay at home, you can basically skip the first 10 years of compounding compared to this Elon Musk example. And then, of course, it would be almost impossible for you probably to reach 66% on the stock market. But there are some ways, for instance, to reach, say, 27% compound annual growth rate, maybe with real estate, maybe with some leverage, that doesn't wipe you out, right? So for instance, you can take some loans, 10-year loans or so. No financial advice. It's just theoretically it's possible if you take some loans and we simply buy simple stocks. I mean, this kind of compound annual growth rate can be done, I think, at least over 1 or 2 decades or so, and especially with small sums of capital. And but even if you have a very modest, say, 10% compound annual growth rate, so let's just make this a 10% compound annual growth rate, but we don't start with 1K, maybe we start with 10K, right? So we start with 10K. Even then, we would reach the 1.4 million threshold, at age 67. And if we would add 10K every single year during this period, we can significantly accelerate this period. And in other Things to videos, in the last week, I have shared many strategies of actually accomplishing this with stocks, but there are obviously other ways as well. Just search for assets with highest compound annual growth rate and you will get some backtesting on Google. Good. One thing I found notable in this list is who is the compounder with the highest compound annual growth rate. Basically, it's Mark Zuckerberg. Interestingly, why is that? Because Mark Zuckerberg already is one of the richest person in the world, not the richest. He has 167 billion, fortune of 167 billion, and he has started with very modest means, right? Maybe at age 15, it would be reasonable to assume he has a net worth of 1K, right? We did this for all persons here. So at this young age, basically, he has managed, at the age of 40, he has managed to amass such a fortune. And this is already like more than 10 years earlier than Elon. Elon is already 53 years old, so 13 years older than Mark Zuckerberg. But Mark Zuckerberg already has almost the sum of Elon, right? So it seems to me that Mark Zuckerberg has a good shot of becoming the richest person on the planet, maybe in 10 years, maybe in 5 years or so. Mark Zuckerberg is actually an excellent capital compounder. He knows his stuff, and many people don't actually see him this way. Many people argue that he did many mistakes by shifting the strategy from of Facebook from like social networks to the metaverse. But I think he knows his stuff and he knows the opportunities to keep compounding capital at a very high rate. He has a compound annual growth rate of insane 113%. And obviously another thing that we can learn is that we need leverage one way or the other, right? Either we to achieve this kind of compound annual growth rate, either we need to say really take on literal leverage or debt to accelerate our compound annual growth rate if you want to beat the high compounders here on this list for some period of time, right? Or we need to have leverage in the form of a corporation, for instance, a public equity, or building a company. So if you build a company, then we can actually leverage the skills and talents of other people as well to build a fortune. And if we cannot build a company ourselves, we need to obviously invest in other people's companies. We need to be owners. This is basically the main takeaway of this video. We need to be owners and compound our capital over time in order to be on the right side of change, because all of those people are on the right side of change as well. Okay, so I think that's the main takeaway. There is one maybe little addition I wanted to add. If we are just John Doe or a normal person and we have 10K, then maybe let's just do the exercise. So say we add 6K every single year, right? So we have 6K every single year, and now we take our initial capital, I3, and we add J4. So we add this annual contribution, okay, every single year. And now we repeat the same behavior here, right, until we go to age 67, now we would have reached a Nasdaq of 10.7 million, right? So if we would just start with a very small capital base and we add 6k every single year, we can even start with 1k, for instance, add 6k every single year. Now we actually would reach huge amounts of capital as we retire, like 9 million or so. That would definitely be enough to retire, even at a low compound annual growth rate. So the principles still apply. It's about the period of compounding, and it's about the compound annual growth rate. If you add a little bit of leverage here, we might get 15%. So we have, say, 10% return from the S&P 500. Then we take a small leverage position. Over time, we simply add small amounts of capital, like $500 every single month, and with this simple strategy done over a lifetime, and this strategy can actually be done by our kids, right? We would reach significant wealth, like 67 million or so. And obviously, like as we reach, say, 1 million or so at age 30 something. We basically wouldn't need to add the 6k every single year. We wouldn't need to save the 6k because it would be irrelevant. The compound annual growth rate would be all that is necessary. The additional 6k or so wouldn't make a difference whatsoever to the final sum. We can actually test this. I can prove that this is irrelevant. We simply remove this addition here, and then we pull this whole thing down. So our final result was 66 million. Now, if we skip the $500 per month addition, we go from 66.9 million to 64.3 million. So of course it's like 2 million difference, but it's a difference of, say, 3% or so of our portfolio, which is not so relevant. It could easily be compensated with a slightly higher growth rate here. So at a certain point in our lives, the actual addition that we save on a monthly basis becomes irrelevant. We could even pull out some small amounts of capital, and it also would become irrelevant to the final sum, just because the sum is so big. Okay, so I think there were some valuable insights here. Keep compounding your capital, even if initially it looks slow and small. Be aware that the compounding always looks like this. It's always a curve like this that keeps exploding towards the end, and towards the end is when you need your capital. You don't save for this year or next year or 2 years from now. You save for your retirement, for instance, or you save for a better life in the future, maybe a decade from now, or maybe even for your children. And that's why we often have long compounding time frames. And then obviously, if you can add a bit of spice to your portfolio by maybe reaching a 15% compound annual growth rate, it would significantly accelerate the wealth machine. And then also one interesting fact is that all of those people actually accomplished a high compound annual growth rate by adding leverage. And the leverage can be either, like in Warren Buffett's case, for instance, leveraging other people's money for instance, investing the float that the insurance companies he owned created. So if you pay your insurance premium, you pay now, and you get probabilistically adjusted, you get a sum later, right? So you pay now, you get a sum later. This is the business model of insurance. And by paying now, the insurance just needs to maintain the capital, and it can do with the capital whatever it wants, as long as it can pay out the liabilities or the responsibilities at a later point in time. And during this time, it can invest the money. And Warren Buffett did exactly this. So they used other people's capital and also their own capital, like a mix of it, but their own capital enriched with other people's capital to compound money in great businesses. And Elon Musk went another route. He basically created new huge companies from scratch. And by doing so, he repeatedly created wealth pretty quickly. So he compounded capital very quickly by riding secular trends and creating companies from scratch that would then be put into the marketplace. Bill Gates basically only created one company that was hugely successful, Microsoft, and it remained at the top for a long period of time. That's why he could maintain such a high growth rate for such a long period of time. Mark Zuckerberg also created a company from scratch. Jeff Bezos Bernard Arnault also created a company. So many of those created companies. Some other people on the Forbes list are basically like crypto billionaires or so. Then we have many in China, also business owners. So oftentimes it's like creating a business asset or creating assets and those assets, letting them work for you instead of buying other people's assets. But it's also possible to buy other people's assets if the assets are good enough, as you see in the Warren Buffett case. Just do the compounding for a long period of time and you can compensate even smaller compound annual growth rate so if your goal would be to become one of the richest person on the planet, if this is not your goal, obviously this should, for most of us, it's not our goal, then we can safely cut kind of this compound annual growth rate to smaller sums so that we have a nice little nest egg of like 64 million or so at the end of our lives. Okay, I think that's enough for today. Thanks for watching this video. Give me a like and subscribe and see you in the next video. Bye.